Yesterday saw the worst day in the S&P 500 so far in 2025, and we've also now entered a correction territory. This is essentially where the markets fall around 10% from their all-time highs. That is something that has now been noted, and therefore this is officially, as we said, in correction mode. And we also notice the S&P is now the worst performing global stock market since Trump won the election. Not something you really want to be associated with, and we do have to see how the rest does pan out. But our focus on today's episode is going to be on two companies that reported their earnings after the market close. We're going to cover Broadcom, but we're going to start the episode off with Costco. We're going to talk a little bit about each company, how they performed in their earnings, getting through their quality metrics, and also giving you our own basis of a valuation. And the first one, whilst many people do know the company, just a quick refresher, Costco are essentially a membership-based warehouse retailer. They sell bulk products at discounted prices, offering groceries, electronics, clothing, household goods, along with services like travel and insurance. And they operate on a low-margin, high-volume business model, relying on membership fees for profitability, and they also have their own private label, Kirkland Signature, known for quality, but also affordability. Now, we're just going to point out that the company is down around 1% in the pre-market, that over the last year, this company is up 33%. Year to date, they're up 12%. And over the last 10 years, if you have been a shareholder, you would be up 587%, massively outperforming the S&P. We also want to note it isn't too far off their 52-week high, and Wall Street is the only analyst here who does believe this company is a buy right now, whilst they do offer a yield of around 0.44%. If we were just to point out the company in terms of that latest quarter, we can see their net sales is up 9% on a year-on-year comparable, whilst their revenue in relation to memberships is also up around 7%. Now, we will cover some of this other information very shortly, but let's get into the actual earnings, and we can see they have reported a mixed second quarter. And one thing we always like to do is start off by looking at the headline figures. And one thing that is very surprising for Costco, at least over the last few years, is that they've actually missed on the EPS, which is very rare for this company. They reported $4.02. Market was forecasting $4.11. And we also noticed in terms of the revenue, they did outperform, although just about 63.72 above 63.13. We did also hear about the CEO talk a little bit about the upcoming tariffs, although he did say forecasting this is going to be difficult, whilst the company overall does aim to minimize the cost increases for their members. What's also good to point out is that a third of their US sales are from imports, and less than half of those do come from China, Mexico, and Canada. So whilst those are currently the areas that have been affected by the tariffs, they don't believe it is that much in terms of the proportion of their total revenue. But as we mentioned at the beginning of the episode, this company does work on very high volume, very low margins, and the tariffs in particular will make their margins that much tighter, and therefore they're saying they will need to work with suppliers to mitigate any fallout from consumers. Now, I'm sure you've heard it a lot over the last few weeks, but we are looking around a 25% tariff on Mexico and Canada, doubling the tariff, as we can note here, 20% to China. But in terms of Costco, although we do have to point out this is looking back at the previous quarter, their top line, as noted, 9% increase. And one thing that is very strong with this company is their renewal rate, which currently sits at 90.5%. One thing that they did recently as well, something they haven't done in quite some time, is they actually raised their annual membership fees, as noted, the first time since 2017, although we can see the impact on this increase was just sitting around 3%. And bottom line also came in strong at $1.79 billion, above the same quarter last year at 1.74. So then if we just look at a few slides from their own investor presentation, we can see comparable sales up 6.8%. Their traffic has also increased, so more and more consumers are entering into their stores, and their e-commerce, the sales that have been online, up 21%. So for a company that does rely on very high volume, they are still seeing that increase quarter on quarter, year on year. We also noticed their bottom line up 2.6%, earnings per share up 2.6%, and their margins a little bit of efficiencies, as we can see, plus 5 basis points from the same quarter last year. As we saw at the beginning of the episode, the company does also rely on membership growth, something noted around 6.8% in comparison to Q2 from 2024, and they are looking to increase as well their warehouse expansions, going from 890 by the end of the last financial year, and by the end of this year they anticipate this to be around 915, with 18 stores remaining to be open. We can see 12 of them in the US, the large bulk, 2 in Canada, and then 4 internationally. So if we look at the company's earnings over the next 4 quarters, they do expect all of them to be growth. As we just noted, they did miss their most recent EPS, something that did take us by surprise, given historically they have outperformed. So over the last 4 quarters, they have a 75% track record. Whilst looking at their forward PE based on the EPS for August 25, the company does trade at quite a high valuation of 56.78, which, no surprises, an F on valuation because the sector does sit significantly lower at 16.6. So not only are you paying a 248% premium, but just take a look at the 5-year average, that also sits lower at 40.6, meaning you're also paying a 42% premium to what historically this company has traded for. Now their growth also gets an F, year-on-year revenue and forward-looking in the mid-single digit, whilst the sector comparably does sit at the low single digit, but over the last 5 years they have been growing their top line at a much faster rate, and they also expect EPS over the next 3 to 5 years to grow at 9%, whilst in fact the sector does sit lower at 7.7, but their comparable over the last 5 years does sit higher. So one thing we want to point out, we don't always want to cover companies that you need to buy, must buy. What we also want to figure are there companies that we need to consider either just holding, potentially trimming, or fully selling out of. And one thing we would say with Costco right now is that you are paying for a company, if you are looking to add to your portfolio, one that is growing at a slower rate than the historicals over the last 5 years, one that also is expected over the next 3 to 5 to grow their EPS at a lower rate, but one that is also trading at a premium, not just to the sector, which it typically does, but also trading right now at a premium quite significantly to their own 5-year. In terms of profitability, they get an A+, gross margin 13%, well below the sector at 36%, in line with their own 5-year. Bottom line 3%, slightly below the sector at 4.4%, slightly above the 5-year at 2.6%, and cash the company generates from operations 10 billion, well above the sector at 795 million, but slightly above their own historicals of 9.5. Now we also just want to run through some of their metrics. Dividend safety, 99, very safe. We'll cover these 2 valuation metrics, and they did in fact increase the dividend last April at 14%, meaning we are anticipating an increase to the dividend next month. Now, dividend safety was reaffirmed back end of last year, ultimately meaning a dividend cut for Costco is highly unlikely. And for those that want to see key metrics from the last recession, they increased the dividend during the 07-09 crash. They had above average growth, -1%, S&P -12, and they also outperformed the S&P, -38, the S&P itself, -55. This is a company, as we highlighted earlier, that does increase their dividend at a very generous rate. Over the last 5 years, double digit. Over the last 20 years, 16.7% year on year. And they've also been increasing those dividends on a consecutive basis for the last 20. They're 5 years away from becoming a dividend aristocrat. Now, the other thing that we want to run through is their valuation based on this model. It compares it to essentially the 5-year average forward valuation. Good to note the blue tunnel is increasing over time. This is the expected fair price, but there is massive disparity over the last year between the current price and the upper end of the blue tunnel. That is a signal for severe overvaluation and something that is reconfirmed, even though we highlighted earlier, the company does trade at a massive overvaluation in comparison to the last 5 years. Whilst also on dividend yield theory, which tells us a company is undervalued when the current yield sits above the 5-year, we get another overvaluation signal. In terms of the sector we already highlighted, it does sit significantly lower, so you are paying a premium today, and we will cover our valuation shortly. Then we get to the free cash flow. As always, we focus on that above the earnings, which is susceptible to manipulation by management through accounting. Below 60%, we get that pretty much every year. 15% on a trailing 12 month, 29 over the next 12 months. That is an indication we should expect another consistent double-digit increase to the dividend. And then we get to the free cash flow per share. Consistent increases over the long term is something we want. Maybe not consistent, but it is increasing, as we can clearly see, and expected to over the next 12 months. And then we move to the sales growth. Inconsistent, but still around the 3 to 7% that we want to see at the bare minimum. 6% noted as well on a trailing 12-month basis. And we can see over the longer term, they have in fact increased their top line more than double. One thing they haven't really done over the last 10 years is return excess cash to investor pockets through share buybacks. It has been pretty much flat over the period. And ROIC, one of our favorite metrics, 10% or more, give us faith management are able to effectively allocate their capital, looking very strong over the last 10 years, sitting at 29% on a trailing 12 month. Then we get to the margins, which as we can see, whilst for the operating side we want above 12% as a generic rule, for this industry they do sit pretty much in line around the 4% as we highlighted earlier, and the free cash flow margin pretty much just below that 5%, but this is something we have seen from Costco on a very consistent basis. Net debt to EBITDA then, what we want to see here, and what this highlights in fact, is the dividend safety as well as the balance sheet strength. EBITDA, earnings before interest, tax, depreciation, amortization, below 3 is what we want. That is what we get. Numbers, in fact, are the number of years it would take the company to pay off all of their debt, net of cash on hand. 0 from 2018 onwards, 0 over the next 12 months. So what this highlights for Costco, it won't even take them one day to pay off all of their debt. Very, very strong balance sheet. We also like to highlight institutional ownership at 69%, 21 billion worth of sales over the last year, but a lot more buying at 33 billion. We also noticed that in the most recent quarter, institutions clearly very bullish on this company. Insider ownership, same reflection, 0.18% ownership, 15 million worth of sales over the last year, no buying, but you would have to go to Q4 where we see just under 7 million worth of sales. Now we will show you who these insiders are, but as always, insider selling not necessarily a bearish signal for us. They sell for many reasons, personal and financial. Most recent though, 24th EVP selling 1,400 shares, netting them $1.3 million. Again, information is here if you do want to look. Now let's jump straight into the valuation model where we get $866 today. This is derived from the DCF model. Now we can show you the numbers, the free cash flow in fact year on year. Average growth 67%. Now what we've done today is we have gone for a growth rate moving forwards of 18%, which does sit between the low and medium of 15 and 20%. But as always, these numbers are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Costco or any others. But based on 18% and the discount rate, we get the present value of future free cash flow and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as you can see, 866. Now what we would say, for those that do believe 20% is more appropriate, $990 isn't that far off the current value, in fact downside of only 2%. So if you are buying this company right now, already baked into the numbers is free cash flow growth over the longer term of 20%, and we'll also show you for full transparency 25% indicating just under $1,400, 36% upside. Now today we've gone for a mix of the low and the medium at the 18%, as we do want to be a little bit more on the lower end, and we're not just done there because we do always like to apply a margin of safety. 10%, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward looking data. If you believe that for the company, it would be a buy at $780. But what we're ultimately saying, and probably no surprises to hear, that this company not only trading at a premium to the intrinsic value, the fair price, but also trading quite some way above at $866 versus the current value of over $1,000. Now Wall Street themselves see this valued at $1,090 over the next year. That is upside around 8%. So even they see this as a limited buy, but we'll show you where we see this. 10%, $718, 15% $736, and at 20% just under $700. As always though, do give us your thoughts in the comments below, whether you agree, disagree, or your overall thought. We then move on to Broadcom, which is a global tech company designing and manufacturing semiconductors and infrastructure software. Products power networking, wireless, broadband, and data center applications, and they serve industries like telecom, enterprise, automotive, focusing on high performance and scalable solutions, and the company grows through innovation as as well as strategic acquisition. And this company, unlike Costco, which was down although marginally, is up around 13% in the pre-market after their earnings after hours yesterday, and they're up 33% over the last year. Year to date, whilst they are down 23%, some of that will be recovered at the market open, but still they will be trading down. Over the last 10 years though, massive outperformance of the S&P, up 1,439%, although even when the market opens, it will be trading around the midpoint of the 52-week range, with Wall Street giving this a strong buy, and they do pay dividends sitting around 1.23%. If we just take a look at the makeup of their latest earnings, we can see in terms of the semiconductor solutions, that revenue element is up 11% year on year. Infrastructure software, that has taken the majority of the growth at 47%, and again, the margins we will cover shortly. As the headline does give away, the earnings top estimates on demand for the custom AI chips, and when we do get to the headline numbers, there was a very strong double beat. In terms of the EPS, 160, well above the 149 forecasted, and revenue 14.92, a nice although marginal nonetheless beat versus 14.61 forecasted by analysts. Bottom line, also very strong, 5.5 billion, significantly higher than the same quarter last year at 1.33. And the company is one of the primary data center infrastructures for artificial intelligence. They work on both Google's custom AI chips, as well as providing essential component for networking thousands of other chips together to develop advanced AI software. As we saw, that is where the majority of the growth has come from in this quarter. In terms of specific AI revenue from their total, we do notice here, they actually go on to say 4.1 billion is in relation to this, and that is 77% higher than the same quarter last year. And something that all semiconductors will love to hear is the CEO saying in a statement there is continued strength from what he can see in the AI semiconductor revenue space, and Broadcom in particular are developing custom AI chips with 3 large cloud customers. We also notice over the next 4 quarters growth anticipated, however each one double digit, whilst also having a 100% historical track record, and they are currently valued at 27.4 on a forward basis, but we do anticipate this to climb nearer the 30 mark as the market opens, and they still have an F on the valuation. As we do note, the company is trading at a premium to the sector by around 36%, but also trading above their own historicals by 47%. Growth does look very strong though at a B+, so granted this is one of those companies that we would say does deserve a premium. 44% revenue year on year, sector at 5, their own 5-year lower at 15, forward looking 26%, well above the sector again at 7, and well above their own 5-year at 13, and they expect to grow their EPS 21% over the next 3 to 5, well above the sector comparable at 15, and well above their own pretty much at the same 14.8. In terms of profitability, impressive again, A+, 75% gross margin, sector at 50, their own 5-year a little bit lower at 74, so we do note those efficiencies. But on the bottom line, whilst they sit around 12% above the sector at 4, over the last 5 years it has been higher at the 24% level. We do also note they generate a lot of cash from operations at 20 billion, when the sector comes in at 108 million, and their own 5-year coming a little bit lower at 15.4. Dividend safety does look good at 67 safe, and we do also notice just in December last year they increased the dividend at 11.3%, with a dividend safety reconfirmed at the back end of the year, and a safe score means a dividend cut is unlikely. Now, if we look at their key metrics, we do in fact notice their recession sales were pretty much in line with the S&P, around -12, -13%, and just like Costco, they do like increasing these dividends at a very rapid rate, in fact 33% year on year over the last 10, whilst increasing those dividends on a consecutive basis for the last 14. If we get to the first valuation then, as we similarly highlighted with Costco, pretty much a very similar trend too. Blue Tunnel is increasing over time, but massive disparity between the upper end and where the company sits right now. And no surprises, forward P, as we highlighted earlier, does sit above the 5-year average, and the yield does sit below. All 3 signals today showing us overvaluation potentially, whilst also trading above the sector, as we said, trading at a premium. If we get to the first one, which is, as we saw, the free cash flow payout, one thing we do notice is that it has been below 50% pretty much every year, bar the most recent year. Nonetheless, they still offered a very attractive dividend increase and expected to go lower over the next 12 months. In terms of free cash flow, for the large part, has been increasing over the longer term, but massive growth is anticipated over the next 12 months to $7.47 per share, and their sales growth, whilst very inconsistent, has been very strong in the most recent year at 44% and 40% on a trailing 12-month basis. Sales growth also increasing at a very rapid rate, going from 7 billion 10 years ago to now sitting at 52. But one thing they have done is dilute your position as a shareholder over the years. But as we highlighted, they have massively outperformed the S&P. If they can continue to do that, it probably won't be a worry over the longer term. And ROIC above the 12% we want to see for the semiconductor space, although not every year and not consistently, currently sitting at 14% on a trailing 12 month. In terms of operating margin, we do want to see efficiencies with margins increasing over time. Whilst we do get that from 2015 to the trailing 12 month, year on year it is very up and down, although bear in mind the industry as a whole is fairly cyclical. Free cash flow margin though looking very good, increasing over the longer term. You could argue this is definitely a very strong free cash flow machine. And the net debt to EBITDA, not as strong as Costco where we saw 0 for quite a significant period, but it is meant to be below 1.5, not something we see in 2024 or on a trailing 12 month. Good to see, anticipated to come down though over the next 12 months. In terms of the institutions, well, we see 77% ownership, 30 billion worth of sales, but a lot more buying at 194, the same to be said in the most recent quarter. So again, like Costco, institutions very bullish, but we do get a higher insider ownership at 2%, whilst insider selling in Q1 of 21 million, and we can in fact see the most recent was in fact on the 8th of January, the director selling 4,000 shares. A few days prior, another director selling 48,000, netting them $11.3 million. Now, before we jump into the valuation of Broadcom, just to let you know, we have released our latest free weekly article. We drop one every single Monday morning completely for free to your inbox, where we cover severely undervalued stocks as well as what's going in the market. So click below and you can sign up and read straight away. You'll also be able to gain access to severely undervalued stocks for the month of March. Lots of information as well as the upside that Wall Street themselves see over the next year. And on top of that, you can grab a recently released copy of 32 stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. We then get to updated valuation for Broadcom, where we get $223. Now we can show you the free cash flow. One thing we do quite like is fairly consistent growth on a year-on-year basis, which does sit around 33%. Now, similar to Costco, we have gone for 18% in between both the low and the medium, and this in turn does give us 223, but we'll show you for full transparency at the 15% point, $179, downside of 11, at the 20% point, $258, upside of 29, and at 25% intrinsically 367, upside of 84. As we said though, trying to be a little bit more conservative at the 18% point, also factor in the wider economy, tariffs, and a lot of uncertainty. We do in fact notice there is a margin of safety today at 10%, pretty much where we see this company right now, with Wall Street themselves giving this a $270 price target. They see 35% upside and they are very impressed with their latest earnings. As always, give us your thoughts below. Are you happy with the earnings? Are you a shareholder of either company? And do you see them as a buy, hold, or sell? Don't forget as well to sign up to the free weekly newsletter. Grab those spreadsheets. Come and join us in the Patreon as well, where we do cover our weekly buys and sells. We have been buying given the volatility. But as always, have a great day and we'll see you all on the next one.